Thank you for watching this preview video at xm.com. We'll be discussing the upcoming data out of the Eurozone and the potential impact on the euro. I'm Maria Pachurdiz, and joining me is Senior Investment Analyst Haralambos Pissouros. So Haralambos, the ECB decided to raise interest rates by 25 basis points at its previous meeting back in September. What has the data that's come out since then indicated about the Eurozone economy? And what can we expect from the preliminary PMIs due next week on Tuesday?
Hello, Maria. Yes, the ECB raised interest rates by 25 basis points in September, but with data pointing to a slowing euro area economy, officials hinted that this may have been the last rate hike in this tightening cycle. And to be honest, data continued to point to a wounded economy after the meeting as well. Despite the improvement in the September PMIs, all indices remained below the 50 barrier that separates expansion from contraction. And on top of that, the CPI numbers for the month showed that inflation slowed by more than expected. The core rate that excludes energy, food, alcohol, and tobacco slid to 4.5% from 5.3%, and even the headline rate declined to 4.3% from 5.2%, despite the rally in oil prices during the month. Both rates are more than double the ECB's target of 2%, but recent comments by policymakers that inflation could come down to the target even without any further rate increases, this allowed investors to assign a 99% probability for no action at next week's gathering. In general, investors see only a 15% probability for another hike by the end of the year, and they are anticipating 60 basis points worth of rate cuts for next year, despite ECB officials arguing that for the inflation target to be met, interest rates may need to be held steady. Now, with that in mind, and also taking into account that next Thursday we have the ECB decision, Tuesday's preliminary PMI numbers for October may attract special attention. Although some further improvement is unlikely to significantly raise the odds for another rate hike, it could make market participants take more seriously the steady for longer remarks by ECB policymakers, and thereby they could remove some basis points worth of rate cuts for next year. Now, on the other hand, if the numbers point to deepening economic wounds, this could add to recession fears and perhaps result in an even lower implied interest rate.
So taking all this into consideration, what reaction might we see in the euro?
Now, despite some recovery this week, the euro remains in a downtrend against the US dollar, and anything corroborating investors' view of no more hikes and several rate cuts for next year may encourage the next leg south and perhaps confirm a lower low in the prevailing downtrend of euro dollar. Now, in the case the PMIs point to some further improvement, the euro could see some gains, but as long as all the PMI indices remain below the 50 zone, any recovery in euro dollar is likely to be treated as a corrective bounce within the broader downtrend, especially with US GDP estimates like the Atlanta Fed GDP Now model being revised up after Tuesday's better than expected retail sales. Let's not forget that following yesterday's US data, investors now assign a more than 50% probability for another rate hike by the Fed.
Haralambos, thanks so much. This was a preview video here at xm.com.